After a day like today, we need to take a step back and put things into perspective. So I've got a long-term chart here of the S&P, and I don't see anything in this chart that tells me anything unusual is happening. Now, of course, every time we get an intermediate degree correction, the media always invents some reason for why the end is near. Here, we had the tsunami in Japan. That was going to bring down the global economy. Then it was the end of QE1. The market was not going to be able to survive without QE. In 2011, it was the end of QE2. The market took a big hit. That was clearly the beginning of a new bear market, and we were going down. And there's always a story. At every one of these corrections, there's always going to be a story for why, this is it. This is the end. But I can tell you that these are not driven by a news event. This was the end of QE. This was the market was going to. There were calls that the market was rolling over, a new bear market had begun. Clearly, that's not the case. The Brexit, that was going to take down the European economy. Greece, Greece was going to destroy Europe. The election night shenanigans. Let's see. Korea. Korea was going to start a nuclear war. It never ends. At every one of these, there's always going to be a story. Right now, the story is that the Fed's going to raise, interest rates more aggressively. Well, apparently, nobody has bothered to check history, but the beginning of a rate hiking cycle is almost always beneficial to the stock market. Stocks don't generally run into trouble until the rate hiking cycle gets mature and we get upwards of 5 or 6%. We're barely over 2% or even 1.5% at the moment. We got a long ways to go yet. So and at every one of these intermediate corrections, you're going to hear the same thing. There's always going to be people predicting a 20% correction. I heard it here in March. I disagreed. People told me this was the beginning of the big one. Of course, it wasn't. Same thing in August. We were on the verge of having a 20% correction. Again, didn't happen. Notice that these are all right translated intermediate cycles. And big corrections don't generally happen during a right translated cycle because you just don't have enough time for the move down to develop. Here we had a left translated cycle, and you can see this just had a lot more time to progress. And the left translated cycles will usually make a lower low, which is what happened here. And this was the 7-year cycle low, by the way. So, the cycles that you need to worry about are the left translated cycles, the ones that top fairly quickly and then have a lot of weeks to go down. Cycles that top in a right translated pattern, they just don't have a lot of time for the move to develop. So you don't generally make these lower lows like you did here at the 7-year cycle low. So you can see this was a right translated cycle, pretty mild move down into the intermediate cycle low, and then we had long period of time here into the election. Again, very mild move down into the intermediate cycle low, an extremely right translated cycle into the beginning of 2017. Again, another mild correction, another right translated cycle, another very mild correction, lasted 2 weeks. This intermediate cycle right here has been the most right translated of all the cycles. So there's just, the odds are very, very slim that this is going to be anything other than, it's going to be no different than this, or 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 you get the picture. These are just normal profit-taking events within an ongoing bull market. This is no different. We just had a very long, very powerful, and sustained intermediate rally. Sentiment got exceptionally bullish, and we're due for some kind of correction. So far, this has been extremely mild, hardly even worth the designation of a minor daily cycle low at this point, much less an intermediate cycle low. So let me zoom in a little bit here. All right, so this is the intermediate cycle right here, and you can see this is an extremely right translated cycle. We ran about 23 weeks until we got our top about a week ago. The daily cycle is on day, I believe this is day 52. So even the daily cycle is very mature. So there's just not a lot of time for this move to unfold. So typically what happens is when you get an extremely right translated cycle like this, you need to work off the sentiment. And since there's not a lot of time, if you're late in the cycle, the only way to work off the sentiment is with these big moves down, these kind of a shock and awe type day. And especially after a period of very low volatility for months, this move, which in reality was only a 2% move, is very shocking to investors, and they tend to panic. So this is how we work off the sentiment very quickly during one of these extremely right translated cycles. You just get a very quick move down, and the correction unfolds in a very short period of time. So you get these big down days, and that's what scares everybody out, and it clears out the sentiment, and then you're set up and ready for the next leg up. And this is going to set the stage for this parabolic phase, which began here in January, to become more aggressive, and I'll explain why. Many retail traders started to buy in right here, in the latter part of January, as we were really starting to move higher. This is when most people's emotions give them the all clear. They become convinced that it's a one-way market and we're only going up. Very similar to how Bitcoin investors felt in December, although we're not anywhere close to a bubble top yet. At the top here, the Nasdaq was barely stretched 17% above the 200-day moving average, and at a bubble top, you'll get 40 to 60% above the 200-day moving average. But what's going to happen is once we get the intermediate cycle low, and I'm going to cover this in a lot more detail in the weekend report, but I suspect we've probably got at least a temporary bottom today. We're getting pretty oversold. The McClellan oscillator is extremely oversold, and I suspect what's going to happen is we're going to get some kind of a bounce, maybe the first part of next week, and then we'll get one more leg down that'll at least come down to test this 38% retracement. And you can see a mild ICL would be a move back to the 38% retracement. We're just barely halfway there. So at this point, this is barely even a daily cycle correction, much less an intermediate cycle correction. It's not unusual for intermediate cycle corrections to go 50 or even 61%. I seriously doubt we're going to get 61%, but I really would like to see at least 38%. And here's the reason why, is once we get this bottom, bottoms in the stock market tend to be different than bottoms in the metals. When we get a bottom, the market tends to explode back up. So they tend to be, more often than not, they tend to be kind of a V-shaped bottom. And we're already starting to attract the retail investors here. So when we get our bottom here, I'm going to say maybe it doesn't come next week, but maybe the week of the 12th would be my guess. So I'm going to say maybe a bounce and then a lower low to at least test this $2,700 level, maybe the week of the 12th. And then we get, the typical V-shaped rocket launch out of the ICL. I've gone over this before. The first 10 to 15 days out of an ICL in the stock market will often tack on anywhere from 6 to 8%. And when the retail traders that are starting to take notice of the market, when they see that rocket launch out of this intermediate cycle low, it's going to convince them that this is a no-risk market. And that's the point at which we're going to start to get a flood of unsophisticated investors hitting the ask, and that's what propels the bubble phase of a bull market, is just a flood of unsophisticated investors convinced that they found a sure thing, and they are panic buying into the market. So they're hitting very wide bid-ask spreads, and that's what sends the market, on this vertical move, the parabolic move up into the bubble top. So we are setting the stage for that right here and now. So once we get this bottom, again, maybe it probably doesn't come next week, but I would say the week of the 12th maybe is we get a lower low below this, maybe test this 38% retracement, which would also be a retest of the bull market channel breakout. I'll show that in a minute. But once we get that bottom, and then I think we can almost assuredly expect a V-shaped rocket launch out of that intermediate cycle low. That's going to set the stage for the mass of unsophisticated investors to come into the market and drive the bubble phase of this final move in the bull market. So, this is your chance. You can either change tactics and do something different this time, or you can continue to behave like you have at every other ICL during this bull market. So you can you can do the same thing you did here and panic and sell at the bottom. Same thing you did here, 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 here. At every one of these intermediate cycle lows, you can just keep making the same mistake over and over, or maybe this time you can do something different. Instead of panicking at the bottom and selling, we're selling short into one of these intermediate cycle lows. Maybe this time you do something different. And then here is that bull market channel trend line right here. In one of my previous videos, I commented that that a possible retracement could be to come back down and tag this or retest this breakout, and then that would set the stage for the next leg up in this bull market. And I think the next leg up will be even more aggressive than this one.